Good morning and welcome to our Ashworth Wealth Weekly Market Update. My name is Scott Thomas. I've been away for the last couple of weeks, so it's actually good to be back in the office and good to do one of these updates. As I got ready for this morning, I went back and I looked at some of the things that have been going on over the last couple of weeks. And one thing that really stood out to me, let me share this slide with you. One thing that really stood out to me is there's been a lot of talk about tariffs and the effects of tariffs on the economy. Well, the earnings reports and earnings per share, and let me go back and talk a little bit about earnings per share. We've talked a lot about that in our meetings over the last a couple of quarters, and we look at earnings per share and we also look at the PE ratios, price to earnings, very, very closely as we're trying to figure out where the markets are at. Are they overpriced, underpriced, whatever? And so when I saw this on earnings per share estimates, for what was projected at the beginning of the year, which is the light blue line, versus how they've been adjusted after we have our second quarter earnings as far as earnings per share. The line obviously has gone down, or the estimated earnings per share was projected to be about 8.8% for the year. After the tariffs have come in, and the line right there in the middle on April 8th, once we had the tariffs come into play, that's obviously still in flux, and that will continue to be shaped over the next few months. The 8.8% earnings per share that was projected at the beginning of the year, an 8.8% increase over last year, has now been projected down to 4.4%. So we're going to continue to watch that very, very carefully. A couple of notes I thought were very interesting is we've talked about the big seven stocks that are really driving the S&P 500 right now. It's the same seven, the Magnificent Seven. It is estimated that they will drive earnings this year, earnings growth. About 41% of the earnings growth in the entire S&P 500 will continue to be those seven companies, which is very, very interesting. We're going to continue to watch that. So what does this mean? It means the earnings per share, because of tariffs, look like they're not going to be quite as strong as what we thought they would be at the beginning of the year. Now, we are still shooting at a moving target. There's going to be more news that comes out on tariffs, and as we continue to get news on that, this number I'm sure will adjust again. But we're going to watch this and we'll update this later throughout the year. Let me give you a couple other numbers that we have updated many, many times since the beginning of the year, things that we're watching very, very closely. The inflation rate as of right now is about 2.7%. The Fed has come out and said repeatedly that their target is between 2 and 3%. So we are down significantly. The measures that they have taken as of right now have worked, and inflation looks to be under control. What does that mean? Well, President Trump has come out a number of times and said, look, inflation is down. We've got that number under control. Why aren't interest rates going down as well? That's been a constant battle between the Fed and the White House over the last few months. That's going to be a battle that we're going to continue to monitor. It's going to be very, very interesting. So just to give you an idea, like I said, inflation right now is sitting at about 2.7%. However, the 30-year mortgage rate, and again, we've talked about this before, the rates in Utah are a little bit better than this, but the 30-year average mortgage is still at about 6.87%. What's going to be very interesting is as inflation stays low, or assuming that it stays low, what will the Fed do, and at what point will they start cutting interest rates? The White House would obviously love to see that sooner. The Fed is leery to do that because they don't want inflation to kick back up again. So it's kind of a balancing act that they're playing. But it's going to be very interesting to watch over the next few months what happens. My feeling is if they do lower interest rates, if they feel like they're in a situation where they can, then mortgage rates will go down, car loan rates will go down, all those things will go down, and that certainly will stimulate the economy. So we very much look forward to that, and we hope that'll come sooner rather than later. The next time the Fed meets will be on the 29th and 30th of July. So it's going to be interesting to see what comes out of that meeting. If it doesn't happen or there is no rate cuts in July, then the next opportunity will be September 16th and 17th when the Fed meets again. So again, we continue to preach diversification. It's been very interesting to watch the different asset classes in our portfolio. The international has done very, very well. It's going to be very interesting to watch again through the end of the year as we get to third quarter and fourth quarter, watching inflation, watching interest rates, watching earnings. and all those kinds of things. And we'll continue to update on a weekly basis as we see different things happen in the economy. Again, we love to hear feedback on these weekly webinars. If you have any questions or concerns, or there's something you would like us to address, please let us know. And please feel free to share this with friends or family. Again, good to be with you, and let us know if you have any questions or concerns. Thank you.